All right, today we've got a story about a massive technological shift. But this isn't one of those tales of innovation for innovation's sake. Nope. This one was born straight from the ashes of a global financial crisis. It's all about how a huge regulatory hammer blow basically forced the entire banking industry to tear down its data foundations and rebuild everything from scratch. We're talking about a move from total fragmented chaos to what we now call a single source of truth. So let's dive in and see exactly how it all went down. And this really captures the entire journey in a nutshell. Before the crisis, you have to understand, banking data was just a mess. I mean, it was fragmented across dozens, sometimes hundreds of different systems. The numbers in one report wouldn't match the numbers in another. It meant that the people at the top, the executives, were essentially flying blind when it came to understanding their real total risk. The goal, which pretty quickly became a non-negotiable mandate, was to get to that after state, unified, consistent, and totally crystal clear. So what was the catalyst? What created this massive, urgent need for change? Well, to get that, we have to rewind the clock to the period right after the 2008 financial crisis. It was this moment of reckoning when regulators and, frankly, everyone else woke up and realized the entire global financial system was way more fragile than anyone had ever imagined. And in response to that chaos, the Office of the Comptroller of the Currency, we'll just call him the OCC, they issued what they called heightened standards. Now, let's be clear. This wasn't some friendly suggestion or a best practices memo. Oh no, this was a powerful top-down mandate. It forced the biggest banks to prove without a shadow of a doubt that they had a complete and accurate handle on their risk data, not just in one department, but across the entire organization. Okay, so to really get why this mandate was such a game changer, you have to understand the broken system it was meant to fix. And the core of that issue, the thing that kept everyone up at night, was what's known as the silo problem. So let's paint a picture. Imagine for a second you're a top exec at a huge bank, right? Your credit risk team comes in and they hand you this super detailed report. It looks professional, it's got all the charts, and it tells you everything you think you need to know about the risk in your loan portfolio. So far, so good. But then, at the very same time, maybe a few floors up in a different part of the building, the market risk team has their own report. And here's the kicker. They're using totally different systems, completely different definitions, even different data formats, all to analyze risks coming from their trading desks. Oh, and we're not done yet. Don't forget the Treasury Department. They're over there tracking liquidity risk, which, is basically the bank's ability to pay its bills on time. A pretty important piece of the puzzle, right? Well, their data is yet another separate piece, totally disconnected from everything else. And these are your data silos. Each one is like an isolated tower of information. The data from the credit team literally could not talk to the data from the market team. And because of that fragmentation, it meant that no single person, not the CEO, not the board, nobody, could see the complete picture of risk. And this wasn't just some abstract, high-level problem. This was a day-to-day nightmare for the technical teams on the ground. You had engineers working around the clock, struggling to just stitch together data from all these incompatible systems. A lot of the time, doing it manually. And the worst part? By the time they finally created a report, the data was already out of date. So this all leads to the one terrifying question that boards and regulators could no longer ignore. With data this scattered, how could anyone see the total risk? How could you possibly manage something you couldn't even see? And the simple, scary answer was, you couldn't. And that brings us right back to the regulators. They were looking at this systemic blindness across the industry, and their demand was actually pretty simple in concept, but it was absolutely massive in its implications. What they wanted was a single source of truth. The new rule was, on the surface, deceptively simple. Risk had to be aggregated across the entire institution. That's it. But that one little sentence, that one requirement effectively outlawed the entire data silo model that had dominated banking for decades. Suddenly, fragmented reporting wasn't just a bad practice, it was unacceptable. Okay, so if silos were the problem, what was the solution? Clearly, the industry needed a completely new way of thinking about data architecture. And that need, it led to what we can call the warehouse revolution. So, how did the banks respond? They started building these massive, brand new centralized platforms called risk warehouses. And the concept behind them was actually really powerful. The idea was to create one central hub, one single place to pull data from literally every corner of the bank. We're talking trading, lending, treasury, you name it. And you pull it all in and consolidate it into a single, governed, consistent structure. But let's be real, building this was a monumental task. This wasn't something you could do over a weekend. It required a huge investment in brand new data engineering. We're talking about building these complex ETL pipelines just to get the data out, clean it up, and load it into the warehouse. They had to implement something called master data management, which is just a fancy way of saying they had to make sure everyone was finally using the same definitions for everything. And then you had to wrap the whole thing in these super strict governance frameworks to guarantee the data was high quality and compliant. And the result? Well, this slide illustrates it perfectly. The warehouse became that single lens, that one pane of glass, that let boards, executives, and regulators finally see the risk across the entire enterprise. For the very first time, they had a clear, consistent, and timely picture of what was actually going on. So, what was the lasting impact of this forced revolution? Well, it fundamentally changed things, and not just the technology, but the entire culture of how banks thought about and managed risk. I mean, the impact was absolutely sweeping. Suddenly, enterprise-wide governance wasn't a nice-to-have, it was mandatory. Those old rickety silos, they were torn down, replaced by these powerful centralized warehouses. Data pipelines were built specifically to unify credit, market, and liquidity risk into one view. And all of this enabled consistent, reliable reporting that people could finally trust. The game changed. Compliance wasn't just about handing over a stack of reports anymore. It was about proving the integrity of your entire data architecture. And maybe this is the biggest shift of all. What that OCC mandate really did was elevate data architecture from being this kind of nerdy back-office IT function to a top-tier board-level strategic priority. For the first time, everyone understood that the stability of the entire bank was directly tied to the quality of its data infrastructure. So, if there's one single idea to take away from this entire transformation, it's this. The warehouse revolution brought a critical truth to light, a truth the financial crisis made painfully clear. And it's that risk isn't something you just measure in little isolated pockets. To be properly managed, it absolutely has to be integrated.